Thank you everyone for coming. So as Tim mentioned, I'm going to be talking about dynamic posted pricing for the transaction fee market. So I'm happy Elaine already gave an introduction on the transaction fee problem. But my talk is going to focus more on the dynamic property of EIP 1559 and how we can think about alternative designs for the dynamics of the protocol. So as we all know, so blockchains, they are this decentralized ledger of transactions, which is managed by this global network of miners. And the picture that we have in mind is that miners, when they're creating blocks, they have this option to include transactions, and those transactions and bidders have a lot of users have interest in having that transactions included in these blocks. The problem happens is that the block space is limited. And for example, here in this picture, you see that since May of 2020, probably driven by the demand in decentralized finance, we have seen a lot of interest in using the Ethereum blockchain, which creates this very high congestion in the network. So it creates this natural question, how we can allocate block space to this population of users. In practice, most blockchains, they inherit this protocol that was proposed by Nakamoto in Bitcoin, where each transaction, in addition to its content, it also contains a tip that the transaction is going to offer to a miner to have that transaction included. So in practice, that just means that miners are going to run a first price auction on these transactions whenever there is excess demand for block space. As some of you might know, if you want to go to include a transaction in Bitcoin, you might have to use a tool like this, where you go there and you try to estimate how much you must bid, and the expected time you'd have to wait to get the transaction confirmed. I'm sure, like me, that might sound like a very stressful if you have to every time go and have to estimate how much you have to bid on these auctions every time you want to submit a transaction. In real life, we are more used to what we call a posted price mechanism, which would be something that you'd see in a supermarket or on Amazon, where the seller is just going to put a fixed price, and you have to simply choose if you are willing to pay that price or not. So that's a way more natural mechanism that we are used to in real life. So the research question that we ask here is how we can dynamically price block space, given that we really don't know what the demand for blockchain space is going to be in the future. So what we often have in mind is that we have the blockchain is really trying to price block space, but in practice you have this demand curve, which a mapping from the price to how many buyers would be willing to pay for block access at that point. The dream as a protocol design is if we could know what this market clearing price is, which is the price where the demand would match the supply. One particular challenge in the blockchain domain is that the market clearing price, it might change over time. Like we might have different demands in different times of the day, but not only different times of the day, and different days of the week, you might have a very different demand. So our mechanism, it needs to be able to adapt to this change in the demand curve over time. So inspired by EIP 1559, the idea that we study here, that we consider, is that instead of users being required to submit a tip, users are going to simply report a budget, which is how much they're willing to pay for getting block access. And the way that the protocol is going to proceed is that we're gonna have that each block is going to contain a fixed price, a posted price, and the miners can only choose a transaction where their budget is above this fixed posted price. And bidders are just going to be required to pay the posted price instead of paying their whole budget. So in some sense now, the hope is that buyers would have incentive to review their budget, because now they'll only be required to pay this fixed price at any point in time. In the last step, we are going to compute the posted price for the next block. So my talk is really going to focus on this fourth point, on how we can actually dynamically compute this posted price and different mechanisms that you might have to estimate this price. So for example, imagine we have this instance where Alice, she want to send 10 coins to Bob, and she reports a budget of 1 coin. That means that she's willing to pay at most 1 coin for have her transaction included. So in this example, she can include her transaction in either block 1 or 3, but she cannot include that her transaction in block. A miner cannot include her transaction in block 2 because the posted price for that block is higher than her budget. So the posted price is a property of each block, and a transaction can only be included in a block where that posted price is below the budget. So EIP 59 is very similar to this concept. I actually went live in August 14th. The only difference that EIP 59 also allow users to report a tip in addition to their budget. And the hope is that if the mechanism is able to converge to a posted price that's above the market clearing price, then bidders would offer a tip that's negligible compared to how much they are going to pay. But for this talk, I'm just gonna assume there is no tips. I'm only gonna consider the dynamics of the budget. Now EIP 59 has all the concepts where the bidders, they make the payment of the posted price, but that payment actually doesn't go to the miner. But that's also not gonna be important for the main concept of this talk. So here we study 3 different ways you could have a dynamic pricing, how you could dynamically set prices. So the first one is a realization-based approach, where we simply going to rely on the realization of the previous block. And that's exactly the same mechanism that's used in the EIP. And then I'm going to show some limitations, or like some instabilities that could arise on this realization-based approach, and then I'm gonna motivate the use of the second and the third pricing rule. So the way that EIP 1559 sets its dynamic pricing is on this formula on the top, where the idea is that we as a protocol designers, we have this goal of setting a target realization of our block. So in EIP, we hope to have an realization of half of the maximum block capacity. And we are going to increase the price for the next round whenever the realization is above the target. And we're going to decrease the price whenever the realization is smaller than the target. And we're going to have this constant alpha, which is just going to limit how much price are allowed to change over time. So what can go wrong with this approach? So consider this example where we have 50 slots for sale and we have 100 users. All of these users, they're going to have a value of 10. So they're going to report a budget of 10 in every round. So what happens in this instance where buyers might have a very concentrated value is that the realization of every block is either going to be 1 or 0. Whenever the posted price is bigger than 10, no one is going to buy, so the realization is going to be 0. And whenever the realization is smaller, whenever the price is smaller than 10, everyone is going to buy, and the realization is going to be 1. So the posted price, they're always going to be changing by this factor of 1 plus or minus alpha over 2, and the prices are never going to converge to an equilibrium. So an alternative way you could do it, you could set prices, is what we call a welfare-based approach, where instead of simply relying on the realization of a block, we can rely on the actual bids reported by a user. That's why we call a welfare-based approach, where we are taking a convex combination of the sum of the values divided by the block capacity with the previous price. So in high level, what we are going to have is that each bid included in a block is going to contribute with a fraction alpha VI divided by the capacity of the block. So each bid is contributing to the next price, but the contribution is going to actually depend on the bid that was reported, that was included in a block. So if you consider the same example as before, if we had, we can prove that the price would actually converge to an equilibrium. So for the first case, imagine that the price was above 10. So in that case, we know that no one would buy, so the welfare of the block would be 0. So that means that the prices are going to decrease by a factor of 1 minus alpha. And eventually the price must reach a point that is at most 10, for sure. Once that happens, we go to the second case where the price is at most 10. But in that case, now the average welfare of our blocks is going to be 10. So the next price is going to be a convex combination of the previous price with 10. Therefore, the next price is going to be between the previous price and 10. So that implies now that we are going to have an increasing sequence of prices, but not only increasing the sequence, it's also bounded by 10. So from monotone convergence, we know that that implies that the sequence is going to converge. And in particular, in the simulation in the right, you see that the prices are converging to 10 in this particular simulation. So the next question is actually, okay, even if we guarantee that our mechanism is converging to a price, we ask here in this work is if this price that we are converging is actually a good one. So imagine, for example, that in the previous example, I had converged to a price that was bigger than 10. Since everyone has a value of 10, then the welfare of our mechanism, even though might be converging, would be 0. So our first results actually concern on actually making guarantees that the price that we are converging is actually a good one if we are converting to a price, to a stable equilibrium at all. So for that, under the assumption that values are drawn IID, we show that for the free pricing rules that we study, if these pricing rules are able to converge to a stable price, then they actually converge to a price that would be approximately welfare optimal. So they can obtain a constant approximation of the optimal welfare if we knew the market equilibrium price in advance. So that's the good news. That means that if we are converging, then we are going to converge to a price that's not too bad, that's not too high. So our second result concerns the property of actually if our posted price mechanism would actually converge to an equilibrium. So in the paper, we give us guarantees. We give a characterization of a family of dynamic pricing rules that converge, and we give conditions for convergence there. So I'm not going to define specifically what those conditions are, but for example, for the welfare-based and the utilization-based pricing rules, the condition is similar to saying that if the revenue curve of our mechanism is concave, strictly concave and Lipschitz, then we can show that there is an alpha that we could set on the pricing rule, so that these pricing update rules, they would converge to a stable equilibrium. And we can now borrow from the prior result that once it converges, it's also going to converge to a posted price that's approximately optimal. So before I conclude, let me just motivate to how we could even improve the welfare-based pricing rule even further. So here I have an example of a simulation where imagining where the budgets of buyers are drawn from a Pareto and an exponential distribution. So the case where values are drawn from a distribution of very high variance, as you see, the welfare-based price rule might have very unstable pricing. And that's because it really depends on the budget that was reported by bidders. So if bidders, if you're just stressing on the bid that's reported by bidders, then you might have this very high variance on the prices. You might also be worried about attacks that the protocol could have. And that's why in the third pricing rule, we consider truncations of the contributions for each bid. So we truncate how much each bid is allowed to contribute to the next price, and that avoids this volatility in the pricing rule. So for example, here you see that the prices, they are way more stable when you truncate the values, and you can also recover the same results as before. You get convergence, and you can also get a condition for stability for this pricing rule. So to conclude, so in this work, we study dynamic posted price mechanisms, and the hope of the community is that these mechanisms, they would potentially make pricing the pricing of blockchain space more predictable over time. In this work, we give conditions for this pricing rules to actually be stable, and at this stable equilibrium, we show that it's actually also approximately welfare optimal. Our third point is we show that by using additional information from blocks and not only the realization, we are able to reduce volatility, and in the end, we can also reduce, we can improve welfare that the mechanism is able to obtain. I believe like this area of research has many interesting future directions. Just to mention two, in this work, we assume a very simplistic notion of welfare, where we are assuming that the optimal welfare is just how many, the maximum welfare you could obtain in the blocks. But in practice, bidders might, you have this trade-off between block size and network delay. And that's something that we really don't capture in this work. Another point is strategy proofness, where we like it, posted price mechanisms because they're strategy proof, but in practice users, they might not really care about waiting to enter a block in the future. So many buyers might be willing to wait. So strategy proofness sometimes might be a simplistic notion of to analyze these mechanisms. Another interesting direction is that if you have noticed, the pricing rules I mentioned, they are very reactive. They're really reacting to how the demand is changing over time. But we know that blockchain demand is very sometimes predictable, right? You might expect that the demand on certain times of the day might be very similar, and the demand in the night is very different on the demand in the morning, or different days of the week might have different demands. So potentially we could incorporate and be able to predict demand changes even before they happen, and design pricing rules that are able to predict the demand in the future, not only reacting to the change in the demand that's happening over time. So thank you very much.
Thanks, Matheus. So we have time for maybe a quick question or two. So, you know, members of the audience, feel free to post questions in the Q&A. Maybe one question just while waiting.
Yeah.
One question is about the 1 quarter. So sort of two related questions about if numbers better than 1 quarter are possible. So first of all, the question would be, you know, is that tight for your setting? And then the second question would be, can you prove sort of better bounds, you know, assuming, say, the uniform distribution, or maybe more generally monotone hazard rate distributions? Is that something you've explored?
Yeah, so that's a good question. So we run some experiments, like in experimentally, you actually obtain better. I think you get like 4/5 over some distributions that we ran. But in theory, yeah, potentially this is something that could be improved in theory, because at least experimentally we see that holds better in practice. Yeah.
Interesting. Okay, well, I think we're out of time. Time to move on to the second paper of the session. Thanks, Matheus.
Thank you.
Stefanos, would you like to share your screen?